Okay, dear students, let's start ATX live revision class, and that's lecture number 3 of the live revision class. Let's start. First, we'll be just revising the NIC. After that, we'll be going towards pension, and then we'll be doing a question on income tax and pension as well. So let's quickly revise NIC. NIC is basically chapter number 5 in our notes. National Insurance Contribution. So when we say NIC, National Insurance Contribution, so in case of employment, employees as well as employer, they have to pay NIC. So employment, in case of employment, there's class 1 employee. NIC. On cash benefits, there's class 1 employer NIC also. On cash benefits which employer has given to their employees. On cash benefits. This class 1A NIC paid by the employer on non-cash benefits. Class 1A, that is also employers NIC. Paid on non-cash benefits which employer has given to their employees. Paid on non-cash benefits. Okay. Now, what are the examples of cash benefits? Cash benefits, for example, obviously the salary. If there is any, let's say, commission, that will be a part of cash benefits. Bonus, most of the time you will see in the question salary and bonus. If there is any overtime payment. But a very important point is point number 5. That is approved mileage allowance. Approved mileage allowance. Approved mileage allowance, which is over and above 45 pence per mile. So repeat, approved mileage allowance, which is over and above 45 pence per mile. Now, what do you mean by over and above 45 pence per mile? For example, employer has paid, assuming 65 pence per mile. And let's say employee has used his or her own car for the employment purposes, and miles driven are 20,000. Repeat, assuming employer has paid 65 pence per mile to the employee, and let's say employee has used its own car for the employment purposes, how many miles? 20,000 miles. Now, if I ask you what will be the cash benefit, so how to calculate the amount of cash benefit for NIC purposes? Cash benefit will be 20,000. multiply by 65 pence means 0.65 pound minus 0.45. Because only the approved mileage allowance, which is over and above 45 pence per mile, that is considered as a cash benefit on which employee and employer, they will have to pay class 1 employee and employer NIC. So 0.65 minus 0.45 multiplied by 20,000. I'm getting 4,000. So the cash benefit which comes in while calculating NIC in this small example is 4,000. Okay. And another thing is, if an employee is getting quoted shares in a company as benefit, quoted shares means if an employee is getting benefit in the form of, let's say, shares, and that company is a listed company, then whatever benefit employee is getting due to those quoted shares, that is also treated as a cash benefit. Okay, now what are the rates? And all the rates which I'm just going to write right now, these rates will be given to you in exam. Class 1 employee NIC. Obviously, who will pay it? Who is going to pay? Employee. From £1 till 12,570. That is applicable on cash earnings. Then rates is going to be 0. From 12,571 till 50,270. And these limits are on annual basis, per year basis. These limits are on per year basis. It means if you are calculating, let's say, class 1 employee NIC for an employee, and only he has just started the job, and let's say only 8 months have passed. So then these limits will be time apportioned 8 upon 12. That is 12%. If it is 50,271 plus above, then it is 2%. In case of employer, class 1 employer NIC, obviously paid by the employer. The first one is actually paid by the employee, of course. We know that class 1 employee and employer NIC, they are on cash earnings. From £1 till 9,100. Again, these limits are per year. Applicable rate is 0%. Applicable rate is 0%. 9,101 plus more. Applicable rate is 13.8%. In addition to that, employer also gets the employment allowance of 5,000 per tax year. Employment allowance, that is 5,000. Okay, and you just need to know one thing, that this employment allowance is not available if director is the sole employee in that particular company. So whatever class 1 NIC, class 1 employer NIC, Let's assume that class 1 employer, I'm just assuming, it is assuming 20,000. You will deduct employment allowance. So basically employer will have to pay 15. And class 1 employer NIC, which employer is paying, that will be deducted from the trading profit of the employer. Class 1 employer NIC will be deducted from the trading profit of the employer. Another point is, these limits 9,100 is per year and it is per employee. For example, if you are solving a question and let's say in the question there are 2 employees, then 9,100 it is per year and per employee. But employment allowance 5,000. Entire 5,000 is only per year. It is not per employee. So 5,000 is per year. It is not per employee. But these limit of 9,100 and this is per year and per employee. Now class 1 A NIC, of course, paid by the employer on non-cash benefits. Paid by the employer. On non-cash benefits, for example, let's say the car benefit, living accommodation benefit. In fact, the beneficial loan benefit is also a part of non-cash benefits. For example, living accommodation, car benefit, fuel benefit. The main thing is beneficial loan benefit is also a part of non-cash benefit. ETC, etc. There are many like asset use benefit, gift of asset, all are non-cash benefits. Okay. How do we calculate class 1A NIC? Very simple. Paid by the employer. Class 1A NIC is equal to, you have to take the taxable non-cash benefits. Taxable non-cash benefits simply multiply by 13.8%. Simply multiply by 13.8%. And whatever amount employer is paying as class 1A NIC, that will be deducted from the trading profit of employer. Okay, now let's quickly discuss NIC in case of self-employed. National Insurance Contribution, now we are talking about self-employed. So there are two NICs, one is class 2 NIC, another is class 4 NIC. Class 4 NIC is actually payable on taxable trading profit. Class 4 NIC is payable on tax adjusted trading profit. But here you need to know one thing. For example, tax year 2023-24, assuming there is a trading profit of 1,50,000, tax adjusted trading profit is 150, and in the same question there is, let's say, brought forward trading loss as well, which is, let's say, 60,000. So first we have to deduct the 60. So NIC will be applicable on 90,000. So class 4 NIC you will be paying on 90,000. So if there is any trading loss, first you have to deduct that. Then on the net tax adjusted trading profit, you will have to pay class 4 NIC. So what are the rates? From £1 till 12,570. Number one, it is per year. Rate is 0%. Then from 12,571 till 50,270 again per year. These limits are on annual basis. NIC rate is 9%. And after that, 50,271 plus above, the rate is 2%. And a very important point is class 4 NIC which employer is paying. This class 4 NIC is not deductible from the trading profit. Class 4 NIC which employer is paying, it is not deductible from the trading profit. Class 2 NIC. In case of self-employment, you have to pay two NICs. One is class 4, another is class 2 NIC. So when we say class 2 NIC, so class 2 is actually pound 3.45 per week. But make sure that trading profit, of course, if you have losses, after deducting the trading losses, should exceed tax adjusted trading profit, should be more than 12,570. If tax adjusted trading profit is less than equal to 12,570, then you will not be paying class 2 NIC. So class 2 NIC is paid on, let's say, weekly basis, that is 3.45 per week. But there's a condition of a small profit. The condition says tax adjusted trading profit in case of brought forward trading loss after trading loss must exceed 12,570. Because if it is not exceeding 12,570, then you will not be paying any class 2 NIC. Okay, now. Pension. In our ATX syllabus, there are two registered pension schemes. Is there anyone who can tell us the names of those two registered pension scheme which are in our syllabus? Students, can anyone tell us the names of two registered pension schemes? Let's see. One is personal pension. Okay. What about the second one?
Occupational pension.
Great. Occupational pension scheme. Another is personal pension scheme. Of course, when we say occupational pension scheme contribution and PPC contribution, the issue of occupational pension will only arise when, let's say, you are an employee, you are working somewhere, and your employer is running the occupational pension plan, and you are a part of that plan. Then it is occupational pension. In case of personal pension plan, you can say that individual has taken an insurance policy for his or her retirement age. Okay. When it comes to personal pension contribution, so we know that in case of PPC, whatever individual pays, it is 80%. 20% is paid by HMRC. Another point is basic rate band, which ends at 37,700. It will be increased by gross PPC. High rate band limit ends at 1,25,140. It will also increase by gross PPC. So first, second, and third tax implication for the PPC is adjusted net income reduces by gross PPC. Okay. Now, another point which is very, again, I would say important. What is that? Basically, when it comes to pension, annual allowance for the pension is 40,000. Annual allowance for the pension is 40,000 pound. Annual allowance for the pension is 40,000 pound. Okay. Now, relating to this 40,000 pound, there are number of tax implications. What are that? Number one, the question is, if annual allowance limit for the pension is 40,000, it means I can maximum contribute 40 per tax year. The question is, if someone is contributing less than 40,000, then what happens to the unused limit? Another question is, if someone has contributed more than the 40,000, then what are the tax implication which individual has contributed more than 40? Now let me tell you. The annual allowance limit, which is 40,000, it can be utilized by maximum 4 contributions, like less, assuming gross PPC by an employee, whatever employee has contributed, less employees' contribution in occupational pension plan. If your employer is so nice, chances are less, but assuming, then also less employer's contribution. Either employer is contributing for the employee in personal pension or occupational pension. One or two or both, whatever, you will deduct. So maximum the annual allowance limit will be utilized by 4 contribution. Number one, if an individual has contributed in PPC, so we'll deduct gross PPC. Second, if employee is also a part of a occupational pension plan and contributing into that, so less employees contribution in occupational pension plan. And the last one is, if employer has contributed in any of the personal pension schemes for their employees, deduct that also. Now, there's a possibility, I'm just assuming, let's say after deducting all 4 of them or whatever is available in the question, still you have 8,000. Assuming unused limit is 4,000, 8,000. If unused limit is 8,000, so what are we going to do with this unused limit? This unused limit will be carried forward. This unused limit will be carried forward for next 3 years. For next 3 years and use on FIFO basis. First in, first out. So in case of unused limit, it will be carried forward for the next 3 years and used on FIFO basis. Now, another possibility is, instead of positive, what if the amount is negative 10,000? If your final answer is negative, it means that particular individual, the total contribution in pension, either it is PPC or OPP or occupational pension or both, the total contribution is more than 40,000. So if I'm having an answer of 10,000 negative, it means, let's say the total contribution is 50, even though the limit is 40. So negative shows excess contribution. Now, very important concept. If your contribution exceeds the total available annual limit of 40,000, then excess contribution is treated as annual allowance charge. This 10,000, it will be taken as annual allowance charge. So this 10,000 will be taken as annual allowance charge, and this annual allowance charge is, you can say it is your other income, of course, non-saving income. And on this 10,000, individual will have to pay tax. Repeat, if actual contribution is more than the annual allowance limit, if actual contribution is more than the annual allowance limit, that excess contribution is treated as annual allowance charge. It is like an other income, non-saving income. An individual will have to pay tax on this 10,000. Okay. Now, another concept. Annual allowance limit is £40,000 per tax year. But this 40,000 annual allowance limit also reduces when two conditions are met. Repeat. If two conditions are met, then annual allowance limit for the pension will be reduced. Now, what are the two conditions? Number one is when the threshold income is more than 2 lakh. When the threshold income is more than 2 lakh. Another name for the threshold income is simply, you can say, adjusted net income, ANI. If the threshold income is more than 200,000, threshold, if I just show you the format, just take net income less gross PPC. If your final answer is more than 2 lakh, it means threshold income is exceeding 2 lakh. And the second condition is adjusted income is more than 240. Adjusted income is so basically when two conditions are met, when two conditions are met, then your annual allowance limit of 40,000 will be reduced. Now, what is the format of calculating adjusted income? Adjusted income. Just take the net income, total net income. Then we will add let's say if individual has contributed in occupational pension plan, individuals occupational pension plan contribution, add if employer has contributed for the employee either in occupational pension plan or personal pension plan or both. Normally employers are not so good then, but let's say just add employer's contribution for employee. If employer has contributed in OPPC or PPC, the final answer is adjusted income. If adjusted income is exceeding 240 and threshold income is exceeding 2 lakh, only then annual allowance limit will reduce. Now, what is the formula for the reduction? Annual allowance is 40,000 pound. Annual allowance is 40,000 pound less adjusted income minus 240. Take one, multiply by 1 upon 2 or 50%, it's the same thing. But let me repeat. Annual allowance limit will only be reduced. Annual allowance limit will only be reduced when threshold income is more than 2 lakh and adjusted income is more than 2 lakh 40. And one more thing, students, in ATX, you have to be really good in formats, okay? One, you should understand. Second, you need to memorize them as well. Now, let's say annual allowance, we know that it is 40,000. Assuming, okay, that threshold income is more than 2 lakh and adjusted income is more than 240. Assuming both the conditions are met, and let's say adjusted income is 4 lakh minus 240 into 1 upon 2. Of course, 4 lakh minus 240, you will get 160. 1 upon 2 of 160 is 80,000. But what I'm doing, instead of 80, I'm writing 36. The rule, the concept is annual allowance cannot be 0. It cannot reduce to 0. It cannot become negative. The minimum annual allowance which individual will get, it is 4,000. Either 4,000 or more than that. It cannot go, annual allowance limit cannot be less than 4. It will be either 4 or more. It cannot go below 4. So basically, whenever you come across a scenario where, let's say, your answer is going to be less than 4,000, then you have to restrict yourself at 4. So the concept is annual allowance can be more than 4,000 or 4. It cannot go below 4. Okay. Let me just share the question. Okay, students, attempt this question. This will give you a really good idea of calculating income tax liability, pension, and all that stuff. You should assume that today's date is 1st May 2024. So you can see that the time of the life passes so quickly. I still remember there was a time when the new year 24 started, 2024, and now, Alhamdulillah, we are in 2025. Wow, wow, wow. So the time of the life is just flying. Okay. A1, calculate Shuttle's income tax liability. For the tax year 23-24, 8 marks. Calculate Shuttle's income tax liability for the tax year 23-24. How many marks? 8. A2. Calculate the amount of tax relief obtained by Shuttle as a consequence of gross PPC 120 she made on 6 April 2023. You can assume that no reduction to the pension allowance was necessary. No reduction means entire 40,000 was available. Okay. Let's see. First, we need to calculate income tax liability. And a student from the next class onwards, inshallah, will be, as you know that, slowly and gradually the time period of live revision class will increase and we'll be discussing more and more past papers question, of course, from the Kaplan kit. You should assume that today's date is 1st May 2024, okay? Your firm has been asked to provide advice to Shuttle and 3 non-UK domicile individuals in connection with personal pension contribution, one is PPC, and the remittance basis of taxation for overseas income and gains. Okay. Right now, we'll be just focusing on income tax area and PPC area. Personal pension contribution. Shuttle has been the production director of Dean Limited since 1st Feb 2011. Okay. Shuttle joined a personal pension scheme on 6 April 2021. Very important point is when an individual becomes the member of registered pension scheme, that is either PPC or OPPC, only then all the rules of pension they will apply. Like that individual will be getting annual allowance of 40,000. If contributes more than 40, then we know that it is treated as annual allowance charge. If contribution is less than 40, unused limit is carried forward for 3 tax year, utilized on FIFO basis. But these tax implications will only apply when an individual has joined the registered pension scheme, either one or both. And there are 2 registered pension schemes in our syllabus. One is occupational pension plan, another is personal pension plan. Shuttle's tax position for the tax year 23-24. Shuttle's only source of income is her remuneration from Dean Limited. Okay. Shuttle, wow. Annual salary is 2,04,000 pounds. So I think that's more than enough. Shuttle's only source of income is her remuneration from Dean Limited. This is a substantial increase on the previous year. Okay. Shuttle lived in a house owned by Dean Limited for a period of time during the tax year. So it means not entire tax year, but during the tax year, she utilized the house as well. The house provided by Dean Limited for Shuttle use was purchased by Dean Limited on January 11 for 5 lakh. Annual value is 7,000. Shuttle live in the house from 1st Feb 2011 until 30th June 2023. It means in the current tax year 23-24, Shuttle lived only 3 months. April, May and June. The house had a market value of 8,70,000. So basically right now, the market value point is not relevant because the market value point is only relevant when ownership period is 6 years or more by the employer, and after that the accommodation is given to an employee. But over here what is happening, on a very next month after buying this property, it was given to the Shuttle. Okay, so that is why we will not replace the cost with the market value. After that, what is the other information? Contribution to Shuttle's personal pension scheme. Shuttle has made the following gross contributions. 6 April 21, it is 9,000, then 38, and then 120. It is all are gross contributions. Along with the Shuttle, company was also contributing 4,000 to the scheme in each tax year. Okay. Remittance basis of taxation is not relevant right now. We are not discussing that. A1 says calculate Shuttle's income tax liability for the tax year 23-24. So let us first calculate the taxable income and then we'll be applying the tax rates. Let's try. A1, and we are calculating income tax liability for the tax year 23-24. Salary, we know that is 2,04,000. Along with the salary, shuttle is getting the non-cash benefit of living in a home as well. It's shared. Let's say working one, accommodation benefit. Rent, annual value means rent is 7,000. There will be an additional benefit as well. Why additional benefit? Because accommodation is an expensive accommodation costing more than 75,000 pounds. 500,000 minus 75,000. Official tax rate in the Finance Act 2023 is, official interest rate in the Finance Act 2023 is 2.25%. I'm getting 9,563. 7,000 plus 9,563. I'm getting 16,563. But this 16,563 is for the whole tax year. Shuttle left during the tax year only for 3 months. So logically, the benefit will be 16,563, 3 by 12. So 16,563, 3 by 12. I'm getting 4,140.75. So with a little bit rounding of 4141. Otherwise, if you go for the accuracy 100%, then it is 4,140.75. But it's okay. Take 4141. So accommodation benefit. Accommodation benefit, let's say working one. 4141. There's no other income. So the same answer is going to be your total income. If I add both of them, so I'll get, after adding both of them, I'll get total income, and the same is your net income as well. 2,04,000 plus 4,140 gives us 2,08,141. Now for the personal allowance, we have to check. If adjusted net income is more than 1 lakh, if adjusted net income is more than 1 lakh, then personal allowance will reduce. In fact, if ANI is, if adjusted net income is 1,25,140 or more, then personal allowance becomes 0. Let's check working two here. Adjusted net income. So the net income is 2,08,141 less gross PPC, which is 120. Two lakh 8,141 minus 1,20,000. I'm getting 88,141. Of course, it is less than 1 lakh. So entire personal allowance is available. N is less than 1 lakh. Therefore, personal allowance 12570 is available. So the entire personal allowance is available 12,570. Taxable income. 2,08,000. 2,08,141 minus 12,570. I'm getting 1,95,571. Now let's calculate income tax. Can I say due to gross PPC, basic and higher rate band limits will also increase. Due to gross PPC, basic and higher rate band limits will increase. So let's go for working 3 here. So basic rate band, higher rate band. Current limit of the basic rate band is 37,700 and higher rate band is 1,25,140. Can I say they will be increased by gross PPC, which is 120. So 37,700 plus 120. Now the revised basic rate band limit is 1,57,700. 1,25,140 plus 1,20 gives us 2,45,140. So revised high rate band limit is 2,45,140. Okay. Taxable income which is in front of us, that is 1,95,571. Okay. Basic rate band limit is changed to 1,57,700. 1,57,700 into 20%. And this is in working 3. 1,57,700 into 20%. I'm getting 31,540. Okay. Now from this taxable income, which is 1,95,571, you have to deduct 1,57,700. Whatever comes obviously falls in higher rate band. 1,95,571 minus 1,57,700. I'm getting a difference 37,871. Applicable tax rate is 40%. 40% of 37,871. I'm getting 15,148.4. Leave that 0.4. 15,148. Okay. Now let us check for the annual allowance as well. Because if the contribution is more than available annual allowance limit, then it will be treated as annual allowance charge, which is like your other income, and you have to pay income tax. And applicable tax rates, they will be from the non-saving income. So how many workings we have done so far? Working till working 3. Okay. Now let's check working 4. We know that annual allowance limit is 40,000, but that 40 reduces when 2 conditions are met. Condition number 1 is threshold income is more than 2 lakh and adjusted income is more than 240. But both of the condition must be met, not one, both. So if I just check the threshold income, we know that threshold income in ANI format is same, but still it's better to check. Threshold income. 2,08,141. Gross PPC is 120. 88,141. threshold income does not exceed 2 lakh. Therefore, entire annual allowance 40 is available. So entire 40 is available, no issue at all. Okay, now let's check what happened in the previous years. Working 5. Shuttle became the member of registered pension scheme in the tax year 21-22. Now please listen. In 21-22, we know that annual allowance limit is 40. Shuttle contributed the gross 9. Dean Limited, employer contributed the 4. It means unused limit is 27,000. And we know that this unused limit will be carried forward for 3 tax years utilized on FIFO basis. After that, in the tax year 22-23, limit is 40 minus shuttle contributed 38, employer contributed 4. So in 22-23, they contributed 2,000 additional, but no issue at all. This additional 2,000 will be covered from the unused limit of 27,000. Okay. In the current tax year, which is 23-24, we have 40,000. So logically, in the current tax year, total available limit is 65. Even though the total available limit is 65, but shuttle contribution plus the delimited contribution is far more than 65. So we know that the contribution, total contribution from shuttle and the dean, it is far more than 65. So there will be an annual allowance charge. And that annual allowance charge is treated as other income and we will pay tax on that. So let's show the calculation. Availability of annual allowance. How many workings we have done so far? 4. Now let's go for working 5. Annual allowance available. For the tax year 23-24, how much is total available? So first of all, we'll see the brought forward from 21-22. Available is 40. Shuttle contributed gross 9, employer contributed 4. It was 27. Then 22-23. 4. Shuttle contribution was shuttle. 38, employer 4. 38, employer 4. So from 27,000, 2,000 is used in 22-23. And 23-24, we have 40. Logically, the available is 65, but actual contribution is more than 65. So there is an annual allowance charge. Annual allowance charge. Gross PPC by shuttle is 120. Dean Limited contribution is 4,000. Available limit is only 65, less available Annual allowance limit 65. Actual contribution is far more than 65. 120 plus for 124 minus 65 gives us 59,000, which is annual allowance charge. So the annual allowance charge is 59, and on this 59, shuttle will have to pay income tax. And applicable tax rates are from the non-saving income. Now, you need to know one thing. The taxable income by the shuttle, it was initially 1,95,571. Now we have annual allowance as well, which is 59,000. If I add both of them, let's see what we are getting. 1,95,571 plus 59,000. I'm getting 2,54,571. We are getting 2,54,571. And this 2,54,571 is more than the revised higher rate band limit. It means some of the amount from 59 will fall in additional rate band. Now, how much annual allowance charge falls in high rate band? How will you calculate? 1,95,571 minus 2,45,140. Let's see. Annual allowance charge. Let me use a calculator. 2,45,140 minus 1,95,571. I'm getting 49,569. 49,569. Applicable tax rate is 40%. I'm getting 19,827.6. So 19,828. Now the remaining annual allowance actually falls in additional rate. Annual allowance charge. From 59,000, we will deduct 49,569. Whatever comes, applicable tax rate will be 45%. 59,000 minus 49,569. I'm getting 4,243.95. So 4,244. Here comes the total income tax liability. $31,540 plus 15,148 plus 19,828 plus 4,244. We're getting 70,760. We're getting 70,760. Okay. Let's go to the part 2 of A. Now, what are they asking us? Calculate the amount of tax relief obtained by shuttle as a consequence that the gross PPC she made on 6. Okay. They're asking us what are the tax implications. Which shuttle is getting due to this gross PPC. Now, let me tell you. Basically, what is the tax relief? What is the actual benefit which Shuttle is getting due to this gross PPC 120? How to answer this? You have to recalculate the income tax liability without gross PPC. Then let's see what happens. A2. We need to calculate total tax relief due to PPC, gross PPC. Total tax relief from gross PPC. Now come in. Let us calculate income tax liability without gross PPC. The net income we have calculated. Now please try to understand. The net income is 2,08,141. If there is no gross PPC, please listen carefully. If there is no gross PPC, then entire net income, which is 2,08,141, it becomes adjusted net income. And we know that when ANI is more than or equal to 1,25,140, then personal allowance becomes 0. So which means that taxable income is now 2,08,141. No personal loss. Obviously, basic rate band, high rate band limit will not increase. Income tax. Basic rate band limit is 37,700. Applicable tax rate is 20%. 7,540. High rate band is 1,25,140 minus 37,700. How much falls in high rate band? 1,25,140 minus 37,700. I'm getting 87,440. Obviously, applicable tax rate is 40%. 34,976. Now, from 2,08,141, we'll deduct 1,25,140. Whatever comes, that falls in additional rate band. 2,08,141 minus 1,25,140. I'm getting 83,001. 83,001 into 45%. Applicable tax rate is 45. I'm getting 37,350.45. Leave that 45. 37,350. So here comes the income tax liability if there is no gross PPC. 7,540 plus 3,4,976 plus 3,7,350. 79,866. Income tax liability without gross PPC. And we have already calculated the income tax liability with gross PPC. Income tax liability after gross PPC. In point number 1, we have calculated, what was that? 70,760. Obviously, this is not the only benefit. You can see that income tax liability is more when there is no PPC. But if there's gross PPC, income tax liability reduces. But in addition to that, there is one more benefit. What is that? Actually, the gross PPC is 120. Gross PPC is 120, and we know that whatever actually individual contributes, that is 80%. 20% is paid by actually HMRC. Actually, the benefit individual is getting on 120, but entire 120 is not paid by the individual. 20% is paid by the HMRC, and that is also a relief. So tax relief on pension contribution. On personal pension contribution. Or you can say that paid by HMRC. How much HMRC pays? 20%. Individual will get the benefit on 120, but actually individual has contributed 80% of that. 20% is paid by HMRC. So here comes the total tax relief from gross PPC. So total tax relief due to this pension contribution is 79866 minus 7076 plus 24,000. It is 33,106. So you can see that this pension contribution has given a really big tax relief. Okay. Students, so far we have discussed, we have revised NIC, pension, and other basic concepts. Also, we did discuss in the previous two classes. And we did discuss today one question as well. And you might have noticed, if not, then you should. Today's class was longer than I would say previous two classes as well. Now, what are we going to do in the coming class? That's very important. In the coming class, inshallah, we'll be discussing the rules of revising the rules of property income and employment income. And especially in employment income, we will be focusing more on the area which actually most of the time comes in ATX, that is share based payments and termination payments. So property income we'll be discussing, plus we'll be discussing the employment income. And in our notes, property income comes in chapter number 2, employment income comes in chapter number 3. We have discussed the chapter number 4, which is pension. And we have discussed the chapter number 5, NIC as well. But in the coming class, let me tell you one thing, we'll be doing property income, employment income, and from the pension, we'll discuss one more topic. And the topic is how to get pension benefits. How do we get the pension benefits? In fact, if you give me just 1 minute, so we can discuss today that how to get the pension benefit. Just give me 1 minute. Okay. Relating to that, pension benefits. When an individual gets the pension benefit, right now I'm just giving you a little idea. If you recall, the individual will get the pension income pension benefits when he reaches the retirement age, that is 55 years or more. When individual reaches 55 years or more, then gets the pension benefits. Okay. Can anyone give us the answer? There is one situation in which pension benefits can be taken even before reaching 55 years. Can anyone give the answer on this? Is there any possibility that individual can get the pension benefit before reaching 55 years? Is there any situation where an individual can get the benefit even before reaching 55 years? Students, I'm waiting for the answer. Give me the answer, the name of a situation in which individuals can get the pension benefits even before reaching 55 years. Is there anyone who can reply? Or should I answer? You have 10 more seconds. Can I say individual can get the benefit of pension even before reaching 55 years if death of that individual is proved before 55 years, let's say due to any XYZ disease, if that individual will not live till 55, in that case, that individual will be getting the benefit of pension before reaching 55. Okay. Otherwise, pension benefit, age 55 or more. But I've explained one thing. There's a possibility of getting these pension benefit even before reaching 55 if death of that individual is proved before 55. Now, how that individual gets the pension benefit? Actually, pension benefit is lump sum, tax-free. That is tax-free lump sum, 25% of lower of a amount in fund, that how much fund is available. Second is the lifetime allowance, and lifetime allowance is 1,073,100. Lifetime allowance. The limit of the lifetime allowance is 1,073,100. Okay. So 20 tax-free lump sum, 25% of lower of, that is which amount which is available in the fund, and lifetime allowance. After that, remainder 75%. The remaining 75% fund will be take withdrawal as other income. Withdraw as other income. And applicable tax rates, they will be 20, 40, and 45. Obviously, remaining 75% will be taken as and when required basis, slowly and gradually. And that will be your other income, pension income, and applicable tax rate will be 20, 40, and 45. Depends in the tax year when individual is getting this pension income, either individual is paying 20, 40, or 45% tax rates. Okay, now. The question is, what if the funds, they are more than lifetime allowance? Then what happens? If funds, they are more than 1,073,100, then what to do? It's very simple. Simply, the amount which is more than the lifetime allowance, if that amount is taken as a larger annuity, then there will be a tax charge which is 25%. If excess cash, excess means excess than lifetime allowance, excess cash is used to fund a larger annuity. Excess cash to be used to fund a larger annuity. Then tax charge is 25% on that excess amount. But if individual says, no, I don't want to use the fund like this, I want my entire excess amount right now lump sum. So instead of utilizing that excess amount for a larger annuity so that later on you can get the more benefit by using that fund, individual says no. I want the entire excess amount lump sum in the form of cash right now. Then HMRC says pay us 55%. If individual chooses to take the excess in cash lump sum, then tax charge is 55%. So if you don't want to utilize the excess fund for a larger annuity, then and you have decided to take the entire excess amount, which is over and above the lifetime allowance lump sum in cash, then HMRC says give us 55%. So students, now inshallah in the coming class we'll be discussing property income. Then we'll be going towards employment income, but obviously in employment income, the more focus will be on that area which normally comes in ATX. So these are the two important areas which we are going to discuss. One is chapter number 2, and the second is chapter number 3. So in the next class, after the next class, inshallah, our 5 chapters revision will be completed, inshallah. There are altogether 15 chapters in our syllabus. So please, students, do attend these live revision classes. As I told you, in a very short period of time, you will get the revision of entire ATX. Entire means entire ATX. And you can see that every live revision class, every coming live revision class is having, I would say, the more time than the previous one. Like this class duration is more than the previous 2 live revision classes. So thank you very much, students. See you all inshallah in the next class as well. And do give the feedback on today's class in your respective WhatsApp groups. Thank you.